Okay, can you hear my voice? If you can hear my voice, please type in yes into the communication box. Great. Seems like that is all underway. Just give me 1 second to get this set up and we will rock and roll. Okay. I think we're ready here. It's been a while, so hopefully I'll remember how to share my screen and everything. I want to thank all of you for joining me today, and I clicked on the Q&A button. What we're going to do is we're going to talk about non-farm payrolls and what to expect in the coming in the next 24 hours. Non-farm payrolls is traditionally one of the most important pieces of U.S. data. And let me start by sharing my screen. And I'll just share my full screen so that we can make sure we have just what we need. So taking a look at, I just want to take a look at how oil prices are doing because we've got some live trades on. All right, so anyway, taking a look at non-farm payrolls. As you all may know, non-farm payrolls is the backbone of every economy because basically payrolls pertains to job growth, and job growth dictates the amount of people that is available to spend in essence. So, it's quite important, and is exceptionally important this time around because last month we had a horrific non-farm payrolls report with job growth rising only 38,000. So much more significant improvement is expected this time around. Now, if you look at my quote screen on the right-hand side, what you may notice is that the U.S. dollar is kind of mixed today. It's not necessarily trading higher ahead of NFPs, which is what you would normally think, especially after the better than expected jobless claims, ADP, and challenger job cuts report. The problem is that job growth isn't quite enough. Investors are worried, obviously, about the labor market, but what they are even more concerned about is basically how it impacts Fed policy. And at the end of the day, it's not, even if we get 200,000 job growth or better, it's not going to be enough to push the Fed to reconsider its position about leaving interest rates unchanged this year, and even for most of next year, because the main reason why investors have been so pessimistic about Federal Reserve interest rate hikes is because they've been basically looking at Britain's decision to exit the European Union as a very significant exogenous risk for the U.S. for the financial markets in general and the U.S. economy. Now, of course, Brexit does not directly impact the U.S. economy as much as it may Europe. But I think it's important to realize that it's unavoidable for the financial sector, and particularly banking stocks, to be impacted, and also even business investment decision and consumer investment decisions, because we've already seen the dominoes fall. We've already seen Britain, basically UK property funds halt redemptions, and that's going to turn to weaker earnings for UK banks. That's going UK corporations, any sort of significant, and that could also affect any funds in the U.S. that may be invested in the UK property market. And even, a lot of the big banks in the UK also are big banks here in the U.S. And so they can have a direct impact on how U.S. markets behave as well. So there's a lot going on, and there's a lot of factors to consider. And I think, the Federal Reserve indicated that they need to watch data, and we never thought that 1 month worth of data would be sufficient for them for them to basically pull the trigger of raising interest rates, and especially not so this time around. And so, with non-farm payrolls in general, I think it's important to realize that there's a couple of very strong leading indicators that tell us that job growth this month is going to be healthy, aside from the natural rebounds that you would anticipate after such an abysmal report in May. If we go back to June, for example, or we go through the data since June, for example, let me just pull this up. We've got a number of leading indicators for non-farm payrolls that we typically follow. And the leading indicators for non-farm payrolls are basically the following. They are Challenger. We already went through some of them. Hold on a second. Basically Challenger layoff reports, and it's a smaller amount of Challenger layoff reports. We actually look at 8 leading indicators for non-farm payrolls every single month. And so one of them is Challenger layoffs. So there's fewer layoffs. ADP reported a rise in job growth, but this is not really a major increase. I mean, I think the market was hoping for a number greater than 200,000. Jobless claims have been very low, but low jobless claims does not less firing does not equal to greater hiring. And the greatest risk going forward is that the uncertainty in Europe could delay a lot of hiring decisions in Europe as well as in the US. ISM non-manufacturing index is actually our most important leading indicator of NFPs, and that's really what gives us the greatest cause for optimism, because we look at the employment component of non-manufacturing ISM, which basically measures service sector activity. We saw the employment component rise from 49.7 to 52.7. So a very, very nice increase. And that increase definitely bodes well for the report, and I think signals to us that we could have greater than 200,000 job growth. Manufacturing sector also saw an improvement. We had contraction in May, and that it returned to expansion in June. So both numbers signal a lift in labor market activity. So right now we looked at 1, 2, 3, 4, 5, even continuing claims are lower. 6 items that tell us that job growth should be better. And the last 2 are basically confidence measures. Consumer confidence index rose very nicely. And then the University of Michigan Consumer Sentiment Index, look at it from a historical perspective, it's the only one that kind of faltered a little bit. So every single quote unquote leading indicator for non-farm payrolls that we follow tell us that job growth should be better. And I think that's very significant, because that suggests to us that we could very much be in a situation where these forecasts could be blown out. So, we already talked about how the market's going to take this piece of data with a grain of salt. There will still be a immediate reaction, in the sense that, regardless of how unimportant non-farm payrolls may be for the Federal Reserve's monetary policy decision, it's still a very significant indicator, and it's still very volatile. And, we're still looking for a big deviation or big change, and that will still be enough to drive some sort of volatility and action in the US dollar. So what's expected? Job growth expected to be 180,000. Unemployment rate expected to rise. Average hourly earnings growth expected to hold steady. So what we're looking at is, first and foremost, if we do get a change in non-farm payrolls in excess of 200,000, I think it's going to be enough to lead to a little bit of a US dollar rally. Of course, we're going to have to watch average hourly earnings and unemployment rate. the rally is not going to be significant unless job growth exceeds 275,000, in my opinion. And average hourly earnings is really key. If we get a bump up in earnings, that's going to be that's going to extend the gains in the dollar. But if we get a pullback in earnings, that's obviously bad news. So, um, yeah, so the risk is to the upside, which is part of the reason why we've bought some dollar yen leading up to the NFP rate decision. We've gone long dollar yen. We may even exit it, ahead of the NFP report if we're into some decent profits. On the downside, there is always room for disappointment, but because the market has a very lofty forecast, but I don't think that that's likely. Nonetheless, the quote unquote area of disappointment that we're looking at, with anything short of, I think, 125,000 is going to be a big disappointment, as well as if average hourly earnings growth is slow. The market is weaker numbers can have much more exaggerated reaction on the markets than a stronger number, because it would validate the market's fear that the Fed is done for the next year or two. And so, we're obviously going to be watching that closely. With regards to the currencies to trade, dollar yen has been very weak. The weakness in dollar yen has been largely driven by the drop in U.S. yields and the fact that the Fed, the market is underpricing Fed. The market is underpricing Fed tightening, and so. Sorry, the market's under Fed tightening. There are lower highs, lower lows, but I think NFPs, or in the lead up to NFPs, we're going to see a rise in the U.S. dollar. I think we're going to see a rise towards 101.50, during the sessions. Last night, the rally that we had came during the European trading session. And so I think, we're going to probably base around 101.50 or so, and then maybe even move higher as a result of that. So, we're looking at dollar yen. We also have Canadian employment reports, which could be softer given the deterioration in Canada's economy. So if we do get that, we could see we get the combination of weaker Canadian data, stronger U.S. data. We can see much more explosive growth in dollar CAD, with resistance up at 130, 120. So right now we're in long dollar yen trades, we're in long dollar CAD trades ahead of non-farm payrolls. We may not hold them through non-farm payrolls. It really depends upon what market factors are looking like, but that's definitely what we're focusing on. The New Zealand dollar is very, very strong. If we get a weak number, I think the best performer is going to be a New Zealand dollar. We're going to run up to 73 cents. Even if overall, we talked about how the number doesn't matter. So if we're lucky enough to get a pullback to 71.75 or so, that could be a good level to come into Kiwi dollar. So that's some of the things that we're watching out for with regards to the New Zealand dollar. Generally speaking, the more important non-farm payrolls report, I think, is going to be the September one, because that's going to be the lead up to the big September monetary policy announcement. So that's really what investors are going to be focusing on. They're really going to look beyond that. Overall, yield plays seem to be key these days, and I think that's where the greatest opportunities are, which is relative value plays in Aussie, Kiwi, against some of the major currencies. We're seeing a lot of big moves, some new record lows in Aussie, Kiwi, Euro, Kiwi, Pound, Aussie today. So some pretty significant moves that we're seeing, all around here. So we don't have many people in the room today, so I'm going to let you fire away with any questions that you may have or any charts that you may want to look at. You have to go to the Forex live video feed in order to see the charts that are, in order to ask questions. So feel free to ask any questions. Any questions that you may have? Pound is still on a very pronounced downtrend. 130 tried to break 130 today. It failed to break 130. We've been selling pounds. We've been buying euro pound. I think you may have the opportunity to buy euro pound in a little bit more of a dip. And maybe back towards the 85 handle, but in general, dips should be bought. And I do see some good opportunities there. And we're watching the pound crosses fairly closely as well. Any questions? Seems like risk is still trying to come off, so we may get a little bit of a pair back in some of these moves. I also like Euro Kiwi quite a bit. We tried shorting it yesterday. We got a little bit of a profit on there, a pretty nominal move. But I think that there may be some more juice in this trade. But, Kiwi's getting a little rich. So we do have a little bit pullback on risk. I would say, Kiwi could pull back on the 60-minute charts to about at least 71.80, which could give us a better entry for Euro Kiwi. I think the ideal entry for Euro Kiwi would be closer to the 80 levels, 53.80. Any questions from the folks in the room? Maybe even 70s. Okay, seems like we have a pretty quiet group here. So I'll give you another opportunity to ask any questions that you may have. No questions? Okay, it's a really active day for our BK members. So if there's no questions, I'm gonna have to drop off and tend to our trading, and focus on what's going on in that part of the opportunities. All right, thank you so much for joining me today, and have a great trading day.